And if there is one interaction and if there is one voice which everybody really looks forward to, at least on ET now, is Manish Chokhani. He's got years and years of experience, his ability to connect the market dots, his ability to really pick up the next big trend. And like he always, mentions that his ability to really identify where the puck will move rather when the puck has moved, I think is quite extraordinary. So, with great pleasure, let me now welcome Mr. Manish Chokhani on ET Now. And good morning. Thank you for joining us. Is that you? Is that you, Manish bhai? You're looking
Morning,
different. Is that age, wisdom, or experience on your face now?
It's age, too much travel.
Looking fresh after the travels.
Yes. At least someone is smiling in this market. So good to see that you've got a smiling Manish Chokhani.
I was thinking of wearing a green shirt, then I saw the screen and I went back to white.
The markets have taken a nasty knock. Everybody knew that this was coming. It is just that when it hit us, nobody was prepared for it.
Yeah, it's true. Even I never thought that we have a bubble in the market because the large caps actually hadn't really participated. And the bubble we used to always talk of was occurring in the small caps and the SME type IPOs. And that's where the pain has obviously been the maximum. And earnings have dramatically slowed down. So I think, you keep everything aside, keep what is happening in US, keep everything happening in China. If our earnings had held up, we could have dealt with all of this. The reality of life is our earnings are not yet holding up. And therefore, one has to go through this period of readjustment.
Manish, I think the bigger question on everyone's mind is how much more pain, and especially for the Janta who's coming into the markets post-COVID, they've not really seen this kind of a gut-wrenching fall.
Yeah, well, I think everyone, including me, has been saying for a while that we have to get our earning expectations aligned. That if the return on equity of India Inc. by and large has been 15%, and that's typically been, the returns that the index has given over 20 years, 10 years, whatever. You can't be making 25, 30% compounded for 4 or 5 years and then not suffer some consequences of that. So I think that period of adjustment was very much required. I remember all of us from the markets were in this very famous now Jaipur Jamboree in December. And the mood was also quite unanimous over there that the markets have run far ahead of themselves. The best case would have been that if the markets had just gone sideways and allowed earnings to catch up with with valuations. However, markets have actually corrected downwards to start, giving people a chance to look at things that they may want to own for a longer term. And we say it very well that in bull markets, you rent stocks, and in bear markets, they return to their rightful owners. So bear markets actually for investors is probably a good thing, that stocks that you want to own for a longer duration of time, hopefully can now fall into your portfolio basket as well.
Manish, did you just call this a bear market? I know in technical parlance, we have entered into one for the small caps at least, but one was hoping that this was just a very, savage bull market correction at best.
No, the bull market uptrend, which is the structural long-term thing for 10, 15 years, I don't think I'm saying that is over. The country is still going to be growing in double digits in nominal terms. Earnings will still be growing in double digits in nominal terms. But if valuations, for example, on mid caps are still closer to 30 times than 20, and for the small caps are beyond 30 times, even today after this correction, you have to understand that these valuations are not sustainable, especially given the interest rates that are prevailing in the world and in India. And therefore, there is pain ahead. I would still think in the mid and small, there is still pain ahead. The large caps are now, at the long-term levels, which are, I think, 19 times forward earnings. But like when you go up, you exceed it on the upside. It also happens on the downside that things don't just end because they are realistic. They end when they become unrealistic and they become so mouth-watering that even someone like me who, for example, may not like to buy a lot of capital goods or commodities, even someone like me gets interested over there. But that is not yet there. I think we still have some room over there.
So, Manish, let's divide the market in two parts, and I'm just breaking it for our viewers. The reason why markets have sold off is because valuations were high and earnings have slowed down. Now, what exactly are markets pricing in? Where to your mind are the valuations and where do you think earnings are headed?
Nikunj, I think we are still optimistic about earnings as a market. Because if I'm looking across my screen, other than say financials and maybe some metals and a few assorted here and there, the rest of the sectors are still pricing in as if in 3 months or 6 months, everything will get corrected and earnings will re-accelerate and go back to a 20% type growth trajectory. I don't think as yet that is realistic, especially given the uncertainty which is being caused in the rest of the world by the way Mr. Trump is, unleashing his tariff war across the world and creating uncertainty. Also in India, despite the stimulus that has been given to the middle class by way of budget cuts, 1 lakh crores is not some number which is going to suddenly unleash great consumer demand. It's always welcome, and it's a great move which was done. But the reality of life is that until we start some revival of a capex cycle and a job creation cycle, this earning acceleration is not going to come. And for that to happen, the corporate sector actually honestly has to pick up the slack this time. That the government has really done whatever it could in terms of giving you tax cuts, in terms of giving you rebates, in terms of giving you freebies as well to encourage. Also the PLI schemes and so on. It just comes down to you need a period of digestion after a party that we've had for 4 years. So sometimes it's just good that, like you say in the middle overs in a 50-over match, that sometimes just keep taking the singles and the twos and don't keep trying to hit boundaries. And wait for your time, because those bad balls are going to come your way, where prices for us to buy things will sometimes get mouth-watering. And we're just waiting for that.
So, Manish, I'm just again breaking it for our viewers, and perhaps we lean on your experience. There are two ways to create wealth: buy something which is small, potentially could become big, or buy something which has become cheap and is trading below its intrinsic value. So if you have to identify both these pockets, what is new and could become big, and what is good and is looking cheap?
So the second one is obviously easier, that the good which has become cheap, which we've spoken for some time, has been financials. And while last year we went and participated a lot over the last 2 or 3 years in capital market type financials, I think the time to come back to not only NBFCs but also some of the private sector banks which hadn't performed for some time. Like you would have seen, even in this kind of big sell-off, it's the erstwhile favorites HDFC, Kotak, and Bajaj Finance which have come back. Whereas in the 2-3 years prior, we had leaned very heavily into public sector banks, for example, because of just how cheap they were. So while that trade is realigning back to the better quality, better run financials, on the smaller ones which are going to become large, I think the market has got a bit overexcited with all the new themes which have come out. And I called out, I think, including in your show, even things like Zomato and all, which are absolutely great companies, that the market's paying too high a price too early for the potential which is there. And I remember I pointed out the example of Infosys speaking in 2001 at a $45 billion market cap. And it's only basically doubled over the last 20 odd years. So while the company and the business can do well, valuation is really what you have to be very cognizant of. And for whatever small thing, even I tend to buy things, and I'll give you a number which I always use in my head, that however great the business is or however great the potential is, can I foresee that this company is on a 5 multiple 5 years forward? Because that allows me to think about the business 5 years out. It allows me to see what I expect the multiple of that business to be 5 years out. If I get it wrong, assuming I bought a decent type business, I'll at least end up at a 15 type multiple, which means I'll triple in 5 years. And if I'm lucky, I'll get to a 25 multiple, which means I'll make 5 times in 5 years. And I don't think those sorts of opportunities as yet exist in our market. So I'm patient with the amount of cash which I was fortunate to create. And I'm sure I'll get a chance to deploy over the coming months.
So one is banks and financials, Manish, but I think the bigger question that everyone is now also pondering about is what to avoid. When the market does come out of this abyss, are you going to see newer sectors emerge as leaders, and what will continue to remain underperformers?
Aisha, actually, if you look out 2 years from now, I don't think people have realized for example, ICICI Bank will cross the earnings number of Infosys. Uh, the SBI and HDFC Bank will be approaching the profit numbers of Reliance. So the absolute number of money which is going to be made by financials, which people will then wake up to and see the rate of change is in favor of financials as opposed to erstwhile leaders of IT, which currently will have a good time because of all this mess going on in AI. People will need them. But when you're looking at terminal values, these are businesses which are going to be beneficiaries of AI by applying them into their businesses. They will start saving their costs. And the fact is that the market is going to consolidate into the better and better and better well-run financials. So I don't think people have as yet realized, the mega theme which is playing out in financials, because we got sidetracked by the fact that three, four of these good companies went nowhere for 4 years. But the time I think for leadership to re-emerge back with the well-run financials is very much here. The capital market leaders will continue to do well, but this 25-30% type compounding in AUMs, it's a cycle. So when the markets will correct, people will go back to banks, and maybe 2-3 years later they'll come back to capital market stocks and so on. But it's within this overarching theme. I don't think people as yet have enough financials in their portfolio, because largely it's been sold down by the foreign investors looking at what's been happening to interest rates in America. And if and when that money does come back, which I think is a matter of time, the biggest beneficiary of inflows in India is going to be financials. So I can't stress that enough. It is the cheapest and the best sector to own in India, and a beneficiary of all the trends which are coming, including artificial intelligence.
Well, when you say banks, Manish, is it a basket? I mean, do you look at the smaller PSBs as well, or do you restrict yourself to the large caps and the financials from within the large caps that you just talked about?
No, personally for me, look, it's my own money. I don't manage public money, so I have the ability to say I can sit on things which I want to own forever and be like a partner in that business with maybe it's a 1%, 2% of that company. But yet it's helpful to think in that terms, and it is going to get increasingly differentiated, that people who are able to attract deposits because of trust, people who have better technology because of the apps and other services that they're putting out, and people who are able to give you quality of service. It's very clear that the leaders, and I'm not just saying it will be the Bajajes and the Kotaks and the HDFCs and ICICIs, but there are even smaller banks which are starting with that advantage of being tech enabled. And I've named some of them in the past, and I'm hesitant to do it in this market, especially given the froth which is still there in the mid and small ones. But long-term wealth creation is not going to happen, unfortunately, in public sector. It will happen in private sector. Not that some of the public sector are not well run, but over time, as the leadership of the bank changes and the ethos of the bank may change, it's very hard to take a 5-year call on some of these. So you can trade some of the PSUs, but I don't think you can be a very, very long-term owner.
Manish, I'll pick it up from our last conversation, which was before Diwali. And before Diwali, there was, I won't use the word sugar rush or gold rush, I would use the word mad rush. Because there was a mad rush in AI-dominated companies. There was a mad rush in manufacturing. There was a mad rush in solar, wind, clean, and green. So let's take these themes one by one. Who will be the eventual winner of AI 3 years out?
In AI, I think of it the way it happened with the internet, that we are not really players in the making of the AI, just like we were not makers of the internet, but we were big beneficiaries of it. And as an example, like in internet, what happened is that people who were using the internet, for example, I was running a brokerage and an investment bank at that time, and it made my distribution cost to go global uh, basically negligible. And that gave a big fillip to our business over there. The same thing I think happens with AI, that this entire middle layer of management, which is sitting, taking data from the bottom of the pyramid and transferring it to the top of the pyramid, the entire middle layer of a lot of companies can vanish. And that's why I say, for example, one of the biggest employers in our country is the service sector, where the entire middle management layer of financials, of even the IT companies, will tend to actually get obsolete, and just make these companies a lot more efficient. If you turn, for example, to the second theme which you talked about in terms of renewable, I do think that's a very, very long-term, powerful theme which is still running. Valuations in some cases are not sustainable, but the theme itself is very, very powerful. That we will have to invest a lot more into our own energy security, and whether it's wind or it's solar or it's nuclear, anyone who's playing into that, including the transmission players, there's very, very long room, for years ahead, for money to be made over there. I would just, watch out for valuation, because again, like, people take the 10-year story and then they pay up for the 10th year, immediately. That's really what one has to be cautious against. Because as an investor, the only thing in your hand is the price you pay at entry. After that, everything is in the hand of Mr. Trump and the market cycle and the politicians. So it's best to be a bit cautious when you're buying, and then be optimistic in whatever you're owning and see how high the market can take it. And when it takes it to an excess, you trim, like everyone did last year, and create some cash and wait for the next cycle.
Second is clean, clean, lean. I'm talking about this entire, excitement which happened in solar companies, wind companies. Is there merit in betting on energy transition? Because that's one big theme which is very popular with a lot of savvy market investors. What
No, it
is your
is.
understanding, and where is that theme headed?
No, it is. It is a very, very powerful mega theme, and we have to create hundreds of gigawatts of power over there. And it's not going to happen with the traditional power. And as our country progresses, there will be a J curve of energy consumption, because as you get richer, you don't just go and buy a car and you don't just go and buy a mobile phone, you end up consuming a lot of energy as well. And we haven't invested in energy really after the blow up of 2007-8, when all these power companies went downhill. So that power shortage in India and the demand for power in India is a long-term trend. And within that you want to be a lot more green and clean, is something inevitable. All I'm saying is that we may have paid up a lot in advance for some of these companies. Like, I heard you talking about the whole EV story, before our show started. Now, EV is a trend which is going to come, but who's going to be the winner and what price you have paid for it is something. When you look across the world, you see the devastation in valuations which has happened over there. So while the BYD may be one big winner, it's not like Tesla, which was considered to be the big winner, is coming out, in better light against a BYD. And then there are players like Xiaomi and all who have come out, which have completely blown even the minds of, for example, the CEO of Ford Motor, to say that this is the car I want to drive and I can't, get myself to stop driving it. So while trends are very, very powerful, all I'm saying is we look at trends and then we look at valuations. And I'm again saying, if the company is going to be growing so powerfully, does it get to a 5 multiple 5 years out? If it's not, that means I'm paying a bit too much for it, too much in advance.
Okay. Now, let's talk about platform companies and the ring of Zomato, the buzz around Paytm, what Policy Bazaar is doing. It's quite extraordinary. These are high growth companies. They are gaining market share. Digital economy is the real deal. If one has to take a 3-year view, let's say in a Zomato or a Paytm, or for that matter, any digital platform service provider, can these stocks create wealth? And I just want to elaborate on that point for the benefit of our viewers. Companies will grow, but will the stock prices grow? That is the point.
The stock price, as I said, will grow, but it may not grow in the percentage terms which you are imagining. I'm again giving you the example. The finest company in India, Infosys, peaked at a $45 billion market cap in 2001. And today it's, I think, 90 or 95 billion. You've made a little more than that because the rupee obviously went from 40 to 90 or thereabouts now. So it may be 2 times in dollar terms, but it may have been 4 times in rupee terms. But 4 times in 20 years is not an interesting rate of return. And it did not cross its previous top for the next 10 years. The same way the Nasdaq made a top in 2001, it did not take out that top till 2013. So you can have a decade where you lose compounding, and then you catch up from there. So if you're buying some of these companies, on 100 multiples and 150 multiples, your time horizon can't be 5 years. It can't even be 10 years. It probably has to be 20 years. And in that 20 years, there shouldn't be any accident where anything goes wrong. And therefore, the advisable thing to do is just wait for your time. You don't have to participate in every single company that goes up. While Infosys was going up, people made money in Wipro also. They eventually made money in TCS also. So it's not that you had to go and say, I have to make my money only in this stock. So you will get enough opportunities. Our country has 500 companies which ought to be bought by someone or the other in their portfolios. And at different points in different cycles, opportunities do come. And because of the excesses which have happened in mid and small caps, there are a lot of funds which will be ending up selling these as they get redemptions or the fund manager changes or whatever reason. And when they sell these mercilessly because it's not stock which they own themselves personally. It becomes then a basket sell. And at that point, the stock prices which you get when you are standing to buy in the market can sometimes be unbelievable. And like I said, when it goes up, it looks unbelievable. When it goes down, also sometimes it can get very unbelievable. I'm just waiting for that.
It's almost getting there. It's all looking very unbelievable. But Manish, you just talked about platform companies, and there were multiple caveats that you put. One of them being that you got to think of a 20-year time horizon to actually hold them, and you gave the example of Infosys. So where is it that you think money can be made in the next 2 to 3 years, other than financials?
Aisha, every day you don't have to buy stocks. All I'm saying is if you have cash on the side, let's just wait for our time. Today, there are certain stocks which have come to a decent price, but that doesn't mean other stocks may not come to an even better price. So while the mainline index at 19 times is now attractive, and within that, it's the financials which are attractive. The mid caps are not yet attractive. Maybe there are two or three over there, but when the entire basket will melt, you will get a lot more chances there. And small caps have already shown you that they just suffer from lack of liquidity. So a lot of the prices that one saw were actually imaginary prices because no one could really sell at those prices and get out. So in a market cycle like we're going through now, the first phase of sell has happened and people are coming and buying the quality companies like I give you example of this Bajaj Finance or Kotak and HDFC and so on. But the other ones which are melting, there will be in some of them which will be good quality, which will also get thrown out. And it's a matter of patience. You have to think like a company doing M&A. You don't go and do it every day. You wait for a time and a season when there's distress and people actually are going to be calling you up and saying, why don't you, buy this block? It's available because this fund needs liquidity. So things like that are likely to happen. I hope it doesn't for everyone's sake. But, in previous cycles, you've seen that this has repeatedly occurred. So just waiting for that.
The other big transition, and I'm talking about mega trends here, just for the benefit of our viewers, I'm simplifying it further, and further. One big trend is energy. Second big trend is AI. Third big trend is digitization of the economy and platform companies. The fourth trend, and which in a sense everybody is now talking about very openly, is EV versus ICE. Who will survive? Will it be the incumbents? Will it be the challengers? Will it be back to the ICE companies, or it will be EV all the way?
Uh, Nikunj, I don't think anyone has the answer because India may not yet have built out the EV infrastructure. So the early adopters, will buy it. Like my own son is one of those. But it may be this country goes the route of hybrid because then the car just starts off on your ICE engine and then that itself powers your EV and you don't have to be dependent on going and charging somewhere. So we don't know how this game plays out, which is why everyone is trying to, sell all the basket of products in their portfolio. The Indian companies have, like Mahindra and all, have responded really well to it. I'm not so sure on the offerings of some of the others, including the leader like Maruti. I'm not so sure what products they will bring out. And there is certainly room for this market to be overturned, the way we've seen it happening, for example, very recently in the paints market. Also, the government seems to be in a mood to allow the Teslas and the BYDs to come into India, and their products are materially superior to what we are seeing, in the Indian market. So how that game plays out, what the tariffs will be, only time will tell. It's a space I would not venture in at all because there's no predictability, and I certainly can't look 5 years out and say what the earnings will be over there. But the others which you mentioned, which would be about energy, which could be about beneficiaries of AI, there the winners look far more clear to me. And you don't, like I said, you don't have to win every battle. You need to buy 10 or 15 stocks to make your portfolio, and one is happy doing that.
I'll ask you something which, in a sense, we've always avoided, which is that is it time to start thinking global? Which is that maybe not 10, but 5, if not 5, maybe 2% of your wealth, you should now start moving out of India, and there are better options outside India now?
It's a button you always press, and I always take the bait. I do think if we intend to be the third largest country in the world, we cannot behave like frogs in the well, only keeping our market overheated and getting into Goa. And it seems like the old days of controller of capital issues, where someone sat in Delhi and decided how a issue would be priced. It seems the same way that each time the rupee gets inflows, it's the RBI which comes and sterilizes and builds up reserves and prevents the rupee from going up. And on the way down, we see it always then follows the rest of the world, and we tumble down and we put up interest rates. But if at times when we have those kind of massive inflows, it would have been useful to allow little more headroom for Indian investors to go out and put more capital outside. And even personally, my son is involved and he looks at companies globally. The sheer cheapness and the sheer innovation which is coming out of China, also some companies in Europe, and of course America, by and large is leading in a lot of innovation. And valuations also will be surprised. Even a Novo Nordisk, which is leading the anti-obesity charge, has fallen off and come to a 20s kind of multiple. In China, you had stocks which were all at sub 10 multiples, and they are global leaders. And what they've done in the last 10 years, despite not being sort of a big votary of China as a political person, but as an investor, you have to look and marvel at what they have created, including things like if they decided that they're going to be cut out of the semiconductor game or the AI game. You've already seen what DeepSeek and the others have done. But I've seen this even in, for example, they used to be the biggest buyer of luxury goods. And they've created companies like Bossiden, or they've created companies like Praya, which do cosmetics over there, which have taken on the likes of Estee Lauder and the others. They've created companies like JNBY Fashion, Shane, which have completely uprooted the Zaras from there. So in sector after sector, the Chinese have gone and created world-class companies, which Indians, by just being restricted to our own market, have not built that wherewithal at all. And by having tariffs as well as a weak currency, we've just kept our companies and our businessmen protected artificially and not looking to how they need to go and compete with the rest of the world. So certainly as investors, we owe it to ourselves to be looking outside so you get a clear picture of what is happening in the world. And EV was one of the first things one could see. Volkswagen is selling at a 4 multiple and it's trying to create EV. So is Mercedes-Benz, so is BMW. And here, we were going gagas over Tata Motors. So sometimes you just miss the plot with what is going on. Same way, global healthcare stocks trade at 10, 12 multiples because there's a patent cliff coming in 2029 and the world is moving to biotechnology. And here we are paying for generics and now getting scared that what if Trump puts the 25% tariff? What happens to our pharma stocks and what happens to our CDMO stocks? So sometimes we just miss the wood for the trees by being so narrowly focused on our own markets. So investors have to be a lot more global in their thinking and their research. And if you can get your money out to invest globally, by all means, you should do it.
But provided there are limited avenues and limited money, Manish, to invest, what would you pick right now? India, US or China? Because China still one seems like it's more a sort of, tactical play, if you will. I don't know, I could be wrong here.
That's the narrative that China was put in a basket by the American funds and some of the ICs, which I talked to as well, as it's uninvestable because the terminal value can go to zero like Russia. And that narrative became so powerful that that whole country has been, kept aside by the global investors. And they completely got blindsided by the pace of innovation and the quality of companies which were built over there. And again, I don't want to sound like too much of a votary of China, but I'm absolutely amazed and impressed with the quality of innovation and the world-class companies that have been created over there. I remember a time 20 years ago when we used to say China doesn't know software, they can only do hardware, and Indian IT will rule. And look where we are 20 years later. There's no question of anyone even thinking of creating a DeepSeek in India. leave alone the Alibabas and the Tencents, which have gone so far ahead of everybody. Look at BYD, which is giving the nightmares to the entire auto industry globally, and Xiaomi, which was a phone company, has become one of the best auto companies over there. So the rate of change and the pace of innovation, even in biotech, they are ahead of what the Americans are doing. So it's like a once in a lifetime opportunity that one is getting to see great companies at low multiples in China, where you can actually take a 5-year, 10-year bet. And the Xi Jinping has finally come out, shaking hands with all these people to signal that we want these people to be wealth creators, and we want these people to be doing innovation and doing their best for their country. And you can contrast it. Would you imagine, a meeting like that happening in India, where we are calling the top 10 or 15 companies and the top 10 or 15 industrialists and actually encouraging them to say, let's go out and conquer the world together. So something has really changed in the world after the coming of Trump, and after this whole change in the narrative on China. I think the game has changed. And if we are playing by the rules of the last 2-3 years, I think we are missing the pitch over here.
Manish, since you always insist that focus on rate of change, if
Yeah.
bad becomes good, buy. If good becomes bad, sell. So, assuming that the big rate of change is around the corner, by the time this rate of change will settle, what will become big? What will go lower? What will get dismissed? And what will be ignored?
Nikunj, right now, unfortunately, the rate of change is going against us. That we were great and we are becoming good. So it's not like we are bad or we are terrible, but we need to really pull our socks up on productivity and innovation. And I can't stop harping, which I do with all my friends who run businesses, that unless we start owning our own IP, building our own products and controlling the technology, and building brands, uh, this B2B type business model, which bulk of India runs on, whether it's in IT or pharma or manufacturing, can only take you that far. To transition from number 5 to number 3 in the world, one will have to be product owners, brand owners, and technology owners. And therefore, the companies that even one looks for in the next cycle will not come under the omnibus label of are they in energy or are they in manufacturing. They will have to be brand, product, and technology companies. And those are the ones which will create the mega caps for us. Let me just pause on that because there are too many people now in India running family offices instead of going out and building companies. But let's see what emerges, because I'm hopeful about the next 30, 35-year-olds who are out there, who are still, unknown. But over the next 5 years, I think some of these guys will come out and build mega wealth for us.
Manish, I'm just going to establish this point for the benefit of our viewers. The firm which Manish represents, Inam Holdings, is one of the foremost investing firms in India, and I've had the interacting with this firm and with Manish Bhai for almost 2.5 decades now. There's one classic report which they've always authored, which is that bet on promoters who are in their 40s, and that has worked like a charm. So let's take that point slightly forward. And this is something which is very close to your heart, and I've seen personally that it is a very important point. Who are the promoters in their 40s whom you are ready to bet on so that they can really be the future leaders?
We spoke about this on Diwali as well, Nikunj, and I think you had put a slide up. And you know, we put up, of course, all these platform company guys who are in that same age group. And from my business, I pointed out to someone like a Karan Bhagat, who's created extraordinary wealth and extraordinary company, and they're doing great kind of things over there as well. So there are enough people. I don't want to give names because it's not my place to do that on television, and I'm not an advisor, and by no means suggesting any company to anybody. But I just find that people in the 40s, they still have that energy, which you could have in your 30s and it carries on in your 40s. And you're still not as burnt out as you tend to get towards as you approach your 60s. So that sweet spot of 40 to 50 is a period in which enormous wealth creation happens. Because after you turn 50, 55, you start looking for glory and prestige and awards. And when you're 30, you may still be doing a lot more impulsive things, which may result in wrong capital allocation. So the sweet spot typically ends up in this 40 to 50 age group. Maybe people are getting a lot more mature earlier now, so maybe you can take it down to 35, 37 as well, but not really going much lower than that.
So if somebody has to bet on Manish Chokhani who's in 50s, what should they bet on?
They shouldn't be betting on me now, that's for sure.
Okay, they can bet on Nikunj and me then.
I'm
We're
on
in
the wrong
that
side
age.
of 40s
Because
now,
you're
Asha.
in the right age, aren't you? Right? Both of you, I think, must be in the 40s, if I'm not wrong. So
Yeah.
right age to be watching ET
Well,
now.
I am. I can raise my hand and say that. With the ladies, we don't ask age
Aisha
on
looks
public
25
forum.
to me.
So nice to have you back. So nice to
No.
have you back on ET now, and thank
Thanks,
you
thanks
for
for
joining us. By the way, there is this Twitter feedback already. Why is Manish Chokhani coming after 6 months? 6 months is a long time. The world has changed. Market has changed. He should come more often to guide us. How do I respond to
Because
this kind of
nobody
inquiry?
invites me. Nobody invites me.
He's been busy traveling. He's
You
sitting
wanna
on
hear-
cash. He's waiting for the opportunities. And yeah, keep calm and travel, right, Manish? That's the mantra.
Yeah, it's best to travel so you don't get tempted and you don't buy wrong things, So then you come back only when there's a crisis at home and people say, come back, we need you back now.
All right, sir. Really appreciate your time. So glad you could join us, and thank you for joining us.
Thanks, Val.
If you like this video, then like, share and subscribe to ET Now.